What is commodity market cornering? Imagine trying to control the supply of a popular product so tightly that you can influence its price. That's essentially what commodity market cornering is all about. It involves acquiring enough of a specific commodity, like metals, agricultural goods, or energy resources, to manipulate its price by dominating the available supply. This is often done by purchasing large amounts of physical commodities or related futures contracts, which are agreements to buy or sell at a set price in the future. When someone controls a big chunk of the supply, they can restrict how much is available to others. This scarcity can push prices higher, allowing the cornerer to sell at a profit once the price rises. Historically, this tactic has appeared several times in the evolution of commodity markets. One famous example happened in the late 1970s and early 1980s when the Hunt brothers tried to corner the silver market. They bought up vast quantities of physical silver and futures contracts, which caused silver prices to jump from about $6 per ounce to nearly $50. Their attempt was eventually stopped by regulators who increased margin requirements, making it harder for them to keep control. This led to a sharp drop in silver prices and big losses for the Hunt family. Another early case took place in 1869 when J. Gould and James Fisk tried to corner the United States gold market. They bought up large amounts of gold, driving prices up, but government intervention ended their scheme. These stories show how attempts to corner markets often lead to regulatory responses meant to keep markets fair and stable. The process of cornering usually involves two main steps: accumulation and manipulation. During the accumulation phase, the trader or group buys up as much of the commodity as possible, either by purchasing physical stockpiles or futures contracts. This requires a lot of money and market knowledge. Once they have enough control, the manipulation phase begins. Here, they restrict supply or create artificial demand to push prices higher. This inflation allows them to sell their holdings at a profit. However, cornering is not easy to sustain. It takes a lot of capital and attention from other traders and regulators. Many jurisdictions consider it illegal because it distorts prices, harms competition, and can destabilize markets. From the point of view of financial history, market cornering shows how traders have tried to influence prices and profits by controlling scarce resources. It also led to the development of rules and regulations to prevent market manipulation. These efforts have shaped the modern commodity markets we see today, balancing the desire for profit with the need for fair trading.